Good morning, and I think by the time I finish, it'll be good afternoon, everybody. Thank you for being here today. My congratulations to Prem and his team. This is the first ever Cafe Alts conference, and we are very, very happy to be associated with it. I realize that I'm speaking to some of the finest minds in the industry sitting here in this room. I also realize that we are all at different stages of evolution in terms of understanding how the AIF industry has grown, is growing, will grow. It's going to be my endeavor in the next 15 minutes or so, and I'll try to compress as much data as I can in the next 15 minutes to show you what has been the journey of AIFs, how does it look going forward, what are the things investors expect out of AIFs. But let me just start off by telling you that, around 3 decades ago, I was at a similar forum making a presentation where at that point of time, mutual funds were alternates. So I had a tough time explaining people, mutual fund, how is it different and all of that. And I think a lot of my friends here would empathize with that. It's extremely gratifying that I have the privilege in my lifetime to be at an industry here today, again, when I'm talking about alternates and the growth of it. But let me just start off. So I was talking to an investor the other day, and he was telling me, "Ye kya hai? Alternate kya hai? Ye to mutual fund hi hai. It's the difference between a shikanji and a lemonade. Shikanji, nimbu pani, shikanji went abroad, worked there, took a degree, और अपने आप को lemonade बुलाना शुरू कर दिया. Mutual fund भी वही है, which actually set me thinking. If this is the general perception, what can we do to talk about it? So my attempt is to make sure that by the end of this conversation, there should be a reasonable difference between, if not a shikanji and a lemonade, but at least a mutual fund and an AIF product. I'm here to give you the big picture and to zoom in. What I'm going to talk about is basically a global perspective on alternates. How is alternates being fueled by the changing mindset of the Indian investor? There's always a demand and supply gap. An industry just cannot grow on its own. There has to be demand. So how is the Indian investor growing? What's the alternates ecosystem in this country today? A lot has been spoken about by the regulators, by my colleagues right now. But what is it actually in terms of numbers, data? How is it growing? And how can you, as advisors, benefit from this trend in terms of alternates? I heard my friend here saying that he's very happy with PMS, and hopefully by the end of it, I'll convince him to look at alternates. By the way, alternates is not just AIF, it's also PMS the way we look at it. So let me give you a global perspective on alternates. You see, one of the key things which is not mentioned in this slide, or not visible in this slide, is that smart money always chases alpha. Okay, I thought this gentleman, he just flattered me. I thought he was taking my photograph, but I realized he's taking the data. I'll send the presentation across to you, not to worry. But smart money always migrates to where alpha is. Globally, if you see, there's been pressure on actively managed funds. And then that moved to passively managed funds. And then smart money started moving into private markets. First private equity, now private credit. So basically, smart money tries to look at alpha, and where it is going is alternates. So as a result of this smart alpha push, you have private equity, hedge funds, real estate assets. They've experienced a boom. Now, interestingly, the only thing I want you to remember out of this chart is the size of the blue sphere, okay, and where it is. This chart shows the growth of the industry, the alternates industry, and the revenue pool. The blue spheres represent alternate assets. So not only are they growing very fast, but at this point of time, and the keyword is this point of time, they're extremely profitable. A lot has been talked about returns from an alternates portfolio. Usually you will see people saying that alternates has concentrated portfolios, returns are very good. But I'm here to argue that it's not just returns, it's risk-adjusted returns. And this is a 30-year study done by Morgan Stanley, wherein they've blended conventional portfolios of 100% stocks, 100% bonds, 50% stocks and bonds, with 20% alternate assets. So as you can see, if you add 20% alternates, and they've defined what alternates it is. It's equity hedge, it's equity neutral, private equity, real estate. You'll find that volatility actually starts coming down. It's down by 26%. Volatility is down by 1/4. And the returns are up by 15% over a 30-year time frame. That's 1/6. So that's the power of alternates in a conventional portfolio. Not surprisingly, alternates are growing very, very fast. In fact, they're expected to be at around 24, 25 or trillion in the next couple of years. We are talking about 2028, which just seems round the corner. And one of the fastest growing segments at this point of time, apart from venture capital, is private credit globally. So why is this happening in the Indian landscape? What has changed in the Indian landscape? Why is the Indian investor suddenly starting to look, and actually not suddenly, it's been 10, 12 years that this industry has been around. Why is the Indian investor starting to take a shine to the alternates business? I think this is the reason. We crossed $2,000 per capita income a few years ago, arguably 2020, 2021. We crossed $2,000 per capita income. Now, typically, whenever you cross $2,000 per capita income, a lot gets talked about in an industry or in a country about consumption habits changing, people getting into a consumption super cycle. You have money at your disposal, so you're not going to buy the same amount of clothes or food. You're going to buy better clothes and more protein in food. But what does not get talked about quite a bit is that the investment habits start changing. And in today's day and age, the change is exponential because we're exposed to so much of knowledge across the industry. So what you're seeing here, this is very interesting. From 2021 to 2031, this is again a survey done by Morgan Stanley. The number of households, with a per capita GDP of 2,200, we are talking about crossing $2,200 of per capita GDP per household. In 2021, there were close to 300 million households. In 2031, there will be 360 million households. But what is amazing is that the pyramid is being inverted. In 2021, the number of households which had US dollar income of around $35,000 and above was around 2%, 5.6 million. In the next 10 years, there's a 350% jump, albeit on a small base, in terms of how this industry, how these households are going to start investing and how much of money they're going to be generating. And the stark thing is in terms of how the whole pyramid is being inverted. You look at 0 to 5,000, it's shrinking rapidly. This is typically what happens in any country when you cross $2,000 per capita income, and it's starting to happen in India. So what is happening? How is it manifesting out there, in terms of investor portfolios? Again, a survey which has been done by various authorities, and you talk about a 10-year time frame between March 2013 and March 2023, you'll find that conventional investment avenues are actually starting to shrink in an investor's asset allocation. Advisors increasingly are talking about more nuanced products. The appetite of an investor in terms of thinking long-term, actually parking money, trading liquidity for returns, understanding risk-adjusted returns is making him move towards more nuanced products. So for example, I think if you look at any conventional avenue, whether you look at insurance, or you look at gold, or you look at property, between 2013 and 2023, there's a marked decrease. In fact, I can show you this even better in the next slide. Investor participation is decreasing very rapidly in traditional products such as cash, insurance, pension funds. And it's actually increasing a lot towards unlisted equity, alternatives, and international assets. Like I said, investors are willing to park money for longer periods of time and willing to explore different avenues in terms of investing money. So the mindset is not just premium consumption, but it's also, quote unquote, premium investing habits. I talked to you about needs of HNIs and ultra HNIs, which get fulfilled by alternates. So this was a survey done, I think, by IVCA. IVCA, incidentally, is the nodal association for AIFs, and I'm part of that. This survey basically talked about why HNIs invest in AIFs. I think the number one thing I've already mentioned is smart money moving towards alpha. HNIs want alpha. Diversification, they want access to both public and private markets. Overall portfolio risk should be reduced, manifested in terms of better risk-adjusted returns. Capitalizing on emerging opportunities. Today's ultra HNI will come and ask you, why should I not be able to invest in a robotics ETF in the US? These are the sort of expectations they have. And of course, managing portfolio volatility, which I talked about. But the fulcrum through which this entire investor need is based is A, wealth preservation, and B, growing wealth. I think that does not change. The mindset that because it's an AIF product, they're willing to take higher risks is actually not true. So as an ecosystem, what are AIFs offering investors? The ecosystem has responded fabulously, which is why you see the growth which is happening right from product innovation. The WTM SEBI was talking about a conducive regulatory environment, the number of products which are coming in, and also consumed by the rising wealth and wealthy in India. More importantly, I think the awareness of such products is self-directed. People are seeking out such products. So the Indian investor now is more aware, more informed, has access to more financial products, and is increasingly looking at niche offerings. Remember, AIFs can have 1,000 investors at max. So if you have a scheme in which investors are coming in and putting in their money, there are like-minded investors moving towards a particular objective. Now, how has the AIF ecosystem developed in India? I think I'm preaching to the choir here when I talked about different types of AIFs, but it's just relevant to spend a moment in terms of what these three categories are. Category 1 AIF is basically angel fund, venture capital funds, SME funds, social venture funds, and infrastructure funds. Category 3 are more into listed securities, long only, long short, hedge funds, and increasingly nowadays debt funds. Category 2 is all which is not category 1 and category 3. So that's how it has been defined. And of course, there are several layers to the different types of investments. Now, let me just share with you how the industry has grown. The industry has grown 10 times in the last decade. You might argue that, we are talking about a small base, et cetera, but look at the size of the industry today. The size of the industry today in terms of commitments is 11.3 lakh crores. In fact, I was talking to somebody the other day, and he was telling me that the amount of money which is there in private credit Cat 2 funds from HNIs is actually more than the amount of money which is in debt mutual funds by HNIs. Okay, and HNI is defined by 1 crore and above. So I think that's a very stark number, if at all that is true. And not surprisingly, Cat 2, which has private credit, that is the largest chunk. It's grown by around 37%. That's 9 lakh crores. And in terms of category, in terms of number of funds, there are 1,300 funds. And incidentally, there are 600 plus AIF manufacturers at this point of time. Talk about competition. So what are the drivers for new fund launches? Niche sophisticated strategies, boutique fund managers who have tremendous entrepreneurial zeal. They want to come, they want to try out new ideas, they'll talk to investors and get money. Established fund houses today have alternate strategies. 60% of mutual funds already have alternate strategies. In fact, Sundaram is one such fund house, and I'll talk a little bit more as we go along. So it's no longer either or, it's both alternates and mutual funds. Very quickly, if I have to just take you through diverse alternates across risk-return spectrum. I mean, there is a vast variety, and that is what fascinates me about this industry. You can never stop learning, you can never stop understanding because so much is happening. Right from venture capital, which gives you an option to participate in social causes, to private equity, which we all know about, just before going public, all of these companies coming. Private credit has now come in a major way, with banks and NBFCs not stepping in. Private credit has stepped in to fulfill needs of working capital, capex. Real estate, you can access different types of real estate, either physical real estate or real estate credit or real estate equity, commercial, residential, warehousing sectors. Long only, a theme which you want to stick with, concentrated exposure can be done. And of course, long short. I think this is something which is catching up very fast. Through a long short portfolio, through a hedged portfolio, you can actually create an all-weather portfolio. I'll just run through the next few slides. I've already got some flashing red on my timing slot. There are multiple strategies available which offer room for innovation. And just see, in the last 10 years, I dare say there's no industry in the country in financial services which offers so many options and has grown over the last 10 years. This basically shows the percentage of strategies across various AIFs. And innovation, of course, is going to drive this further. Now, I have to double-click this very quickly. We are talking about asset categories. Now, if you look at unlisted equity, there's angel fund, venture capital fund, private equity. In credit, there's private credit. In physical assets, there's real estate. And the listed security space, you have long only and long short. And just to pick up, how deep this goes, if you just take private credit is now available in venture debt, mezzanine funds, performing credit, special situations, and real estate. And at the other end of the spectrum, in terms of listed securities, long short, you have an absolute return strategy, you have multi-strategy, you have pure hedge strategy, a market-neutral strategy, and believe it or not, a listed debt strategy. This is all possible through Category 3 AIFs. Now, the Indian AIF ecosystem offers quite unique benefits to investors. I think we have learned from what's happening globally. We have learned from industries, financial services industries in India, which manage money. And the endeavor is to offer unique benefits to investors. I talked about superior risk-adjusted returns. One of the things which is quite unique is you can take leverage. If you have a potential hedging strategy, you can actually take leverage and give better risk-adjusted returns. Some of the best minds in the industry are now turning to AIFs, and as HNIs and ultra HNIs, you have access to them. Access to public and private markets, uncorrelated market exposure. There is very little correlation to traditional markets. You can access any asset class. Access to India's growth story, and then, of course, asset class diversification. You can get into listed or unlisted investee companies, derivatives, units of other AIFs, or complex investment strategies. Now, typically, if you see mutual funds, if you see ETFs, if you see any industry, the first impetus for growth always comes in through institutions. And institutions are already here. 56% of inflows in the AIF industry is currently institutions. You might say 56 is quite a bit. I would argue that in a span of 10 years, non-institutional is already 44%. And that is the state at which it is growing. So domestic individual participation is already starting to climb. And while institutions prefer primarily Cat 2 funds, individuals tend to migrate more towards Cat 3 funds. This is a very interesting slide. You have AIFs now being subscribed across the country. Knowledge is not the domain of the top metro cities. Knowledge is freely available. And if you are digital in your approach, if you're digital in your offering, then I think it can be accessed anywhere. What was amazing for me was to find out that Kanchipuram and Thane region together are actually equivalent to Ahmedabad. So that is the amount of money which is starting to come in, and that is the amount of scope which is there in the industry. My last section, which I'm going to talk about, is basically on what can one do, what should one do if you're an advisor. And an advisor does not necessarily mean a distributor. It means even an investment counselor. How do you actually go and talk about alternates, how to position alternates? Well, this is data from CAMS, and CAMS came up with a very, very interesting report, and this was a slide which caught my attention. What is the proportion of direct versus distributor in AIFs? Cat 1, of course, is predominantly direct, but you will find that Cat 3 is predominantly, in fact, 4 out of 5 clients seek distribution advice when they invest in a Cat 3 fund. Cat 2, it's 50-50, but then if you start to slice and dice the data, you look at private equity, you look at private capital, I think different versions of them. Private equity is more direct. Private credit is increasingly now more distribution-oriented. So we suggest basically a 3-pronged approach to work with the new Indian investor. I think the first thing you have to remember is comfort is more important than conviction. An investor will respect you if you have knowledge. He'll be more comfortable with you. Remember, the guy at the other end is extremely smart. He's probably thinking like a fund manager himself. So you just can't go and sit down with him and say, think long-term, invest long-term. This will not work with him. He wants to get nuanced information. So you have to be up the curve. So, access to knowledge is very, very important. In terms of product suite, there are lots and lots of options. But I think what works best is what you can find as an option for the investors in terms of his risk profile, and see whether they're contemporary and simple at the same time. It's an oxymoron, contemporary and simple, but that's the holy grail as an advisor you'll have to look out to. And of course, digitization. The conventional ways of growth are probably not going to happen here. You need to be making sure that you have digitization to grow. So, what we do basically in terms of partnering with advisors, just to build on this, There's a lot of information we release. You would have got this white paper on quality, with your kit bag. That's something which we released and talked about quality versus value. We've created Sundaram Learning and Information Center, and it's going to be live on our website very soon. More importantly, you can interact with our RMs to get more insights. In terms of products, I think we believe in being transparent, contemporary yet simple. And one interesting thing for you is that probably as an industry player, we have the highest skin in the game in each of our products. Digital experience, I think, very clear. You have to have a digital mindset. And basically, you have online portfolio, our online portfolio evaluation. We disclose portfolios on WhatsApp and what have you. Some of the product offerings which we have, I think it's all there in your brochures. But, just 3 points here. One is in equity, we focus on quality as a factor. In terms of private credit, we are very, very regular in terms of our distribution. We've had 0 delays and defaults even in a real estate fund. Drawdowns are pretty quick. So this is something you may want to just check with our local RM in case you're interested. Not too many people know that we are nudging $1 billion in terms of assets under management. But at our core, we have the heart of a startup and the head of an institution. And that allows us to balance growth with risk management very, very effectively. This is a leadership team. You will be hearing them speak today. They're available here. You can also talk to them. Just a couple of more slides, some of the awards which we have. But the last 2 slides, one is basically, again, I'm probably preaching to the choir here, a comparison of different platforms. And I'm telling you the reason why I'm saying this. I've compared a mutual fund, PMS, and an AIF, right? The regulator is the same, but the types are different. The type of investors are different. The minimum investment amounts are different. Now, why am I stressing so much on the word different? Is at the end of the day, a shikanji may not be very different from a lemonade, but a mutual fund and AIF are similar, not same. Thank you very much, ladies and gentlemen, for your time.